So welcome back. We're going to look at some of the miscellaneous topics left. Maybe not as relevant, but there's no harm in doing them with me. It will not take too much time. So we are now on page 91. We are doing capital gains. Just a few small amendments, changes. We've talked about 911. We've talked about a foreign company which has investment in shares of an Indian company or assets in India, and another foreign company that owns shares of this company. So we say shares of A Limited. We learned that if B Limited transfers shares of A Limited to another company C Limited, then this transfer there is deemed accrual under section 911. And of course we've learned that the conditions will only be applicable if there is these assets have a value exceeding 10 CR and more than 50% of the total assets. But now we are looking at an exemption for this. He says, if the transfer of shares by B to C, listen carefully, if the transfer of shares by B Limited to C Limited and the shares are being of A Limited was in a scheme of amalgamation where 25% of shareholders of B Limited become shareholders in C Limited, and such transfer does not attract capital gains in the country of B Limited. So two conditions. One, shareholders of 25% of B Limited become shareholders in C Limited, and this amalgamation does not attract capital gains in the country of B Limited, then there will be no deemed accrual in India. Similarly, if B Limited in a scheme of demerger transfers shares of A Limited and conditions are fulfilled, then there will be no deemed accrual. So that is one. Secondly, when C Limited sells these shares, and we are now on page number 92, when C Limited sells the shares, the cost of acquisition for C Limited of the shares of A Limited will be the cost for which B Limited had acquired the same. So it will be cost to previous owner. So this basically essentially has been covered by 49.1. So when B Limited transfers shares of A Limited to C Limited, there is no capital gains. When C Limited transfers it to someone else and it is covered by section 911, then while computing capital gains in the hands of C Limited on any subsequent transfer, the cost of acquisition will be the cost of shares of A Limited to B Limited when they had purchased the same. The period of holding, of course, will again start from the day B Limited held the shares of A Limited. So it is basically the same. All we are saying is that cost to previous owner, period of holding of previous owner, but that transfer is exempt. Then there is a B part which talks about on page 92. We are looking at section 47.18. Consolidation of mutual fund schemes. Let us go and read. So he says, because the mutual fund companies had come up with numerous schemes, the government directed, SEBI directed to have a fewer schemes. The Securities and Exchange Board of India has been encouraging mutual funds to consolidate its various schemes having like features. That means if there is a mutual fund company that has come up with one high growth scheme, then you talk about another scheme which is very fast equity oriented funds and so on. Now Mr. X had bought units of 1000 and his value at the present is, let's say, 20 rupees. Now the mutual fund is going to consolidate these two schemes and make it into one scheme. And of course Mr. X will give up his units for scheme 1 and he will get units in the consolidated scheme. Maybe I say he gets 1000 units, but because the value of this fund was going at 25, maybe the valuation is at 22. He incurs again. Now these consolidations were being hampered because the unit holder was being made liable to capital gains tax. So by introduction of 4718, they've said this is not taxable, provided of course, and let's look at the conditions. So he says, any transfer by unit holder of a capital asset being unit or units held by him in a consolidated scheme of a mutual fund made in consideration of the allotment to him of a capital asset being a unit or units in the consolidated scheme of the mutual fund would not be considered as transfer. So forget the English they write. Basically, if you're giving up units and you're getting units in a consolidated scheme, that is exempt. However, this exemption would be available only if the consolidation takes place of two or more schemes of equity oriented mutual fund, of two or more schemes of a fund other than, or of two or more schemes of a fund other than equity oriented. The period of holding in case over here, so I call 1000 units of scheme 1 and these are 1000 units of scheme consolidated. Now the period of holding of these units will be from the date these were bought. The cost of acquisition of these units will be the one you paid for the earlier units, so that the capital gains cannot be manipulated. So that's one. Then the last one we will do is in case of demerger, which I think the amendment was long due, and when I taught demerger and capital gains I mentioned this, that when we look at X limited and Y limited and there is a process of amalgamation, we know capital gains is exempt. Now if there was plant and machinery as on 1/4, if the WDV was 40 lakhs and I say land, I say the book value was 100 lakhs, the cost was 80 lakhs, so maybe there is revaluation here. These were taken over at 60 lakhs by the amalgamated company and this was taken over at 120 lakhs. We had said that in case of amalgamation 49(1) is applicable for a non-depreciable capital asset, which means cost of acquisition of land will be 80 lakhs no matter what you do, neither will this be considered nor this. In case of depreciable assets, as per explanation to section 43(1) and 6, the actual cost to Y limited would be the WDV, which is 40 lakhs. So essentially transfer at a higher price to manipulate depreciation of profits was curbed in case of amalgamation, but 49 was missing in case of demerger. Explanations to 43(6) and 43(1) we've discussed when we've done demerger. We've shown how the assets are to be taken into consideration in the hands of the resulting company. For depreciable assets, we've done the treatment. For non-depreciable assets, 49(1) was not applicable. So maybe what could be possible was that in such a case, if this was demerger, section 219AA defines demerger. It says that assets must be taken over at book value, which means the assets could be taken over at 100. But revaluation would have been possible before demerger, thus raising the cost here and maybe decreasing the capital gains on any subsequent transfer. But Finance Act 15 has curbed that loophole and put demerger under 49(1), which also puts it under 242A. Therefore, now the cost to the resulting company will be 80 lakhs because of 49(1), and the period of holding of the previous owner, which is X limited, will also be taken into consideration. So this becomes the demerged company and this becomes the resulting company. So the same provisions have now been brought into effect for demerger as well. So continuing the small amendments given on page 113 now, I think one of the questions I believe can be asked again. So small amendments. We're looking at investment funds. Let's look at what chapter 23 or section 1023 FB read with section 115U earlier. What were they doing? So we had there's a term called venture capital company, venture capital funds. Now, essentially this section started out for money to be spent in a venture capital undertaking. Any income these guys earned, so investing money in startup companies whose shares are unlisted. We know startups are the future of this country as well. An idea can be turned into a multi-million, billion-dollar company. So people who take the risk of funding people who have an idea must be given a benefit. So this is what we are looking at, people who take a risk. So whatever income they earned by way of their investment, so they must have bought shares here, or they could have bought debentures here. So these people earning income by way of interest and dividend would get the exemption under section 1023 FB. Of course, income of the VCU was taxable. Now, there were people who invested money in these people. So we call them, let's say, unit holder. When the VCC or VCF passed on the benefit to these people, it was taxable in the hands of the unit holder, and there was no additional tax. So essentially what we call this is the pass-through status. And if you've done REITs lecture, you will remember what I had said regarding that. Later, what we need to learn is that in 2012, earlier this was governed by the SEBI Venture Capital Fund Regulation. Later it was changed to SEBI Alternate Investment Fund Regulation. So we now have AIF. So instead of the term VCC or VCF, we now started using AIF, Alternate Investment Fund, which essentially meant the same thing. It was people investing money in startups, unlisted company. Therefore, SEBI AIF regulations now regulate all privately pooled investment vehicles which collect funds from investors for investments in accordance with the predefined investment policy for the benefit of its investors. He says AIF can be a fund established or incorporated in the form of a trust, company, LLP or body corporate. The AIF regulations cover a wide ambit of funds and categorize them into three categories. So AIF regulations categorize private people, private funds into three categories. Category 1 were people who invest in startup or early stage ventures or social ventures or small and medium enterprises, infrastructure or other structures, sectors or areas which the government or regulators consider as socially or economically desirable. So category 1 AIF, funds which invest in startups, in infrastructure, SMEs, these are the backbone of our country. So these were the ones who were getting the benefit of 1023 FB. Category 2 AIF is a residual category and covers AIFs for which no specific incentives or concessions are given by the government or other regulators. Category 2 will cover classic private equity funds and debt funds. Such funds do not undertake leverage or borrowing other than to meet day-to-day operational requirements. So these categories 1, category 2, category 3, what you need to remember is the old section only gave exemption to category 1 AIFs. Now that is all of the past. So we are now going to look at what the amendment says, and I think we will just do one small table given on page 117. So we now say AIF of category 1 and category 2 are eligible for the benefit of the pass-through status. They are investing in undertakings and they have investors. The idea is to exempt their income by way of investment and to pass on the tax to the investor. So the law says that AIFs, if they are directly doing any business, for that they will be taxable. For any other income of the AIF, they will be exempt. And when they pass on the share of their business income, since they've already paid tax, that will be exempt in the hands of the investor. And when they pass on the share of this, that will become taxable because they have not paid tax on it. So it's a pass-through status. Let's have a look. He says, the following table gives a summary of the provisions. Income under the head profits and gains of business or profession of the investment fund. This is AIF, category 1 and category 2. is taxable in the hands of the investment fund. In the hands of the unit holder, it is exempt. Income other than profits and gains of business is exempt in the hands of the investment fund but taxable as if he had directly held the investment, and TDS to be deducted at the rate of 10% on such income distributed to unit holder. Now, if there is any loss incurred by the investment fund, the loss incurred by the investment fund is to be carried forward by the fund itself to be set off in the next year, not passed to the investors. We will just do that. And there is no dividend distribution tax to be applied on income given to the unit holder. So I am summarizing this for you. We say investment fund earns income from business and profession, they pay tax. They earn income from investment, we say other income, they are not taxed. This is from investment in eligible. Whatever they pass on to the people who have invested in AIF, unit holders, this will be exempt, this will be taxable, a TDS of 10% will be deducted. Now, if there is any loss here, that loss will not be passed on. It will be set off in the next years before deciding the tax liability. Now, we are going to look at a question given again on page 118. He says the following are particulars of income of 3 investment funds for the year 15-16. There is fund A, B and C. In fund A, there is no business income. Compute the total income of the investment funds and unit holders, assuming that each investment fund has 20 unit holders, each having 1 unit, and income from investment in the investment fund is only income of the unit holder. So we look at investment fund A. Now, in investment fund A, there is no business income. Therefore, that is not taxable in the hands of A. Capital gains is 16 lakhs and other sources is 4 lakhs. Therefore, these are incomes which are exempt in the hands of A, other than business. In the hands of unit holder of A, each fund has 20 unit holders. So I can actually say 20 lakhs divided by 20, 1 lakh. But we have to do it category wise. So 16 lakhs divided by 20. So 80,000 is capital gains income, same head, and 4 lakhs divided by 20. 20,000 is income from other sources of the unit holder, each of them. Now that finishes treatment of fund A. In fund B, there is business income of 2 lakhs which is taxable in the hands of the fund. In the hands of the unit holder of the fund, distribution of this is not taxable. Similarly, 14 lakhs capital gains divided by 20, here again 70,001, and 4 lakhs of course divided by 20 is again 20,000. These are capital gains and other sources respectively in the hands of the unit holder. We have fund C. Now fund C has a loss in business which has to be adjusted. We know business loss can be set off from other sources. Capital loss cannot be set off, so it will be carried forward. It will not be passed on to the unit holder. So we have other sources income of 6 lakhs and business income is the only income taxable in the hands of the fund. Therefore, other sources income is not taxable. In the hands of the unit holder, when he gets share of 6 lakhs divided by 20, which is 30,000, will be income from other sources. Now he says, if fund C has the following income components, what would be the total income of the fund for that year? In the next year, he says. So we have business income of 2 lakhs, which is taxable. We have a brought forward capital loss of 6, which gives me 3 lakhs. And we have other sources of 8 lakhs. Now in the hands of the fund, what is taxable is 2 lakhs. These are exempt. These will be taxable in the hands of the unit holder. Just a few more small amendments. The rest, of course, as I keep saying, we've already done in the modules. This one we've already done actually, 115A, 1B. This is chapter 12 in the chapter of non-residents. We know if there is royalty or fees for technical service received by a foreign company or any other non-resident, then the same shall be taxable in India. The rate had been increased to 25% last year, but has been reduced back to 10%, which was the rate applicable in 13-14 as well. So that was one change, and that's the only change in 115A. Now coming to MAT, children, we say if there is a company and the company is a partner in a firm, then let's say the company receives a share of profit from the firm, let's say 10 lakhs, and there is a profit here of, let's say, 200 lakhs. Now, while calculating book profits, all incomes exempt under section 10 barring a few need to be removed from book profits. We know share of profit is exempt under section 10 subsection 2A. The logic, of course, is the firm has paid tax on this, so the partner will not be taxed on the share of the same profits. So we would have done 200 and minus 10. Therefore, essentially, share of profit from a firm is outside the scope of minimum alternate tax. Even if there was a share of loss here, that would have had the same. It would have been adjusted while calculating book profits. But if I look at a company and the company is a member of the AOP, now the share of the AOP, and we've done this in assessment of AOPs, so you would need to revise yourselves, share of AOP is not exempt in the hands of the company under section 10. While deciding the rates of taxation, we had said if the AOP is not taxed, that means all the members of the AOP are individuals and the total income of no member exceeds the minimum exemption slab, then the AOP is not taxed. But in this case, all members of the AOP would have been individuals. And I would suggest you revise this if you don't remember, because you can only understand what I'm saying once you've revised the original concept. The AOP is not taxed if the members are individuals. If any one individual member has total income more than minimum exemption slab, then the AOP was taxed at the rates as applicable to the individual. In such a case, the share from the AOP was included in the income of the member, but a rebate of 86 was given proportionate to the tax. Lastly, if the AOP has any member, which is a company, then the AOP is taxed at the maximum marginal rate, which is 30%. In such a case, the share was not included in the share of the member as per section 86, which actually means, like in case of a firm where AOP is not taxed, the members were taxed for their share in the AOP. Where AOP was taxed at individual rates, the share of profits from the AOP were included in the income of the member, but rebate given proportionately, and those are not relevant to the present case because that is only applicable where members are individuals. We are looking at if a company is a member of AOP, then the AOP shall be taxed at 30%. In such a case, the share of income from AOP, share of profits from AOP were not taxable in the hands of the member as per rebate given under 86. Now the problem with this is that if I go back to the same example and I say this is share of profit not of firm but of AOP, Now, while calculating total income as per normal provisions, other than the provisions of 115JB, this 10 lakhs would not be taxable. But because of a clause which does not exist in 115JB, telling me to remove this would not be removed, and the book profits would thus be 200. Now that seemingly was not the intention of legislature. Therefore, this year they have said that share of profit of a company in an AOP which is eligible for a rebate under 86 will be removed from the book profits, therefore bringing it on par with the share of profits from a firm. That is one. Then this is on page number 127, and the other one, amendment in MAT. He says income arising to a foreign company. So let's just go there. So we say income arising to a foreign company from capital gains arising on transactions in securities or interest, royalty and fees for technical service chargeable to tax at rates specified in chapter 12 to be excluded from levy of MAT. So chapter 12, again we know there are special rates. There is a concessional rate of 10% on capital gains in case of GDRs, in case of overseas financial corporations, and there is royalty and fees for technical service, which we just talked about, 115A, which is at a concessional rate of 10%. Now these incomes are taxed at a concessional rate of 10% while calculating total income. These are to be removed from MAT. So he basically says are to be excluded from levy of MAT. So that you can just remember. But this is only in case of course, foreign companies. The amount of income accruing or arising being a foreign company from capital gains arising on transactions in securities and interest royalty chargeable specified in chapter 12, if such income is credited to the P&L account and income tax payable thereon in accordance with the provisions of the Act is at a rate less than 80%, being the rate specified in 115JB, because these are taxable at, as I said, 10%. Therefore, 115JB would result in a higher tax of 18.5%, and we do not want foreign companies to run away from the country.